So it seems like the empire has struck back. This isn't all about Iran though. It's also going to be about what happens on Monday morning when our accounts open and when those markets open. Right now, all around me, I'm seeing jets flying around. I'm seeing military movements. I live in the Middle East, so it's a sensitive region. Don't know if you can see that behind me right now, but up there in the sky, you might be able to see it. But we're talking about markets having to reprice all of these developments in real time. Weekend gold is up sharply as we speak right now. Weekend gold is moving up about 4%. Silver is also up. Oil, understandably, is up 10%. And yes, I said weekend gold, weekend silver, weekend oil. Those things trade on the weekend. It's true. But it's not forced hedging that's going on. It's 100 million barrel a day market, energy system and sovereign monetary hedge system that has to reprice trillions in derivatives in notional value. And by the end of this video, you're going to see exactly where the pressure is leaking right now and whether Monday comes as a continuation squeeze or a liquidity trap. So let's have a little story. Picture Sunday night, futures markets are going to reopen. Spreads are going to be very wide. Liquidity is going to be very thin. Algos are scanning strike maps, not headlines. They're trying to determine what it means if the Strait of Hormuz gets mined. Somewhere, an oil dealer is short tens of thousands of upside calls on the price of oil. Somewhere else, a gold book just went deeply short gamma into a gap. They don't get to wait for the clarity anymore. They have to hedge it immediately. And when the hedge is being hedged into thin liquidity, the price isn't going to drift. It's going to jump, and it's going to jump very, very quickly. So this isn't just about Iran, and it's not just about geopolitics. It's actually also about hedging flows, capital flows, and how the system digests a geopolitical shock of this magnitude and this proportion. And that's where the pressure is going to leak. And that's where the pressure is going to show up. And that's where the gamma and the deltas are going to explode rather than compress. How do we position ourselves in this? And what does it mean for our portfolios? Well, we have to think about what's going to happen on Monday morning, the Monday morning mechanism. So let's anchor the reality with some actual hard structure. No copium, no hopium, actual structure. So global oil consumption is roughly 100 million barrels per day. About 20% of that global supply comes through the Strait of Hormuz. And if you look at that on a map, it's mad how busy that strait is and how much oil passes through it. And obviously, the Strait of Hormuz is controlled and owned by Iran. Any perceived disruption, let alone disruption, in reality, reprices the forward curves of those barrels of oil into the future immediately. It doesn't say, oh, it might be different in the future. It has to reprice it right now. Oil option markets routinely carry massive open interest around round numbers like 20, 30, 60, 70, 80, 100. If oil gaps 8 to 10% into heavy upside call positioning, dealers who sold those calls must do a few things. They have to buy the futures immediately. They have to hedge the delta exposure immediately. And they have to continuously rebalance as the gamma expands. Now, if you don't know what gamma means, gamma is just the rate of change of the delta. So let me give you an example. If dealers are short 100,000 calls with a delta of 0.4, that's equivalent to 40,000 futures of contract exposure. If price rises and delta moves to 0.60 from 0.40, they must buy an additional 20,000 contracts. Now imagine that magnified, imagine that amplified, imagine that increased on a global scale with global institutions, with real market players and with speculators. They're not talking about sentiment. It's mechanical buying, it's pressure buying, it's necessity buying, it's convexity, it's asymmetry. Now multiply that across all of the global desks in the world, all of the banks, all of the oil traders, all of the governments, all of the producers, all of the chemical companies that actually need it, all of the gasoline companies that need it, all of the militaries that need their supplies. That's how you get runaway gaps on Monday morning. That's how you get runaway opens on Monday morning. But here's the withheld piece, because there is some withheld mystery secret knowledge here as well. If those hedges complete and vol stabilizes, the fuel is obviously going to run out. But we're going to get there. Don't worry. We're going to talk about that a bit longer. But just hold that in mind right now, because if the hedges actually complete, there's going to be some different kind of price action going on as well. So let's talk about what this could mean for an oil shock and how gamma, one of the Greeks in options, could lead to the acceleration of the oil price even more. Not just oil prices, but oil companies, equities in things like Exxon, other oil derivatives, other gasoline, all the way down the fractional distillation chain. So oil is the volatility epicenter. It runs and controls everything. In the 1990s, during the Gulf War, some of you might be too young to remember that. I mean, I'm too young to remember that. I wasn't born then. Oil prices doubled in months. In 2019, Saudi Arabian facilities got attacked by Yemeni Houthis, and it triggered a 20% move in oil before it went to a partial retracement. Oil always reacts violently to Middle East instability because it prices in the risk immediately. It redraws and reprices those forward curves, what it thinks the market is going to be pricing it in the future, given the risk sentiment baked into the price and the risk premium. It shifts the inflation expectations, which means it shifts treasuries, it shifts the value of the dollar, it shifts perceptions of consumer expectations of inflation, because obviously with higher oil prices leads to an uptick in inflation. If backwardation steepens on Monday, which means spot price above futures price, that's going to mean real market pricing disruption. The first move is not going to be spot driven. It's always going to be options driven. If the dealers are short the gamma on the oil positions into the gap, the upside is going to accelerate as the demand for hedging gets even more. And if the dealers are long the gamma, they have to sell into the rally. The spike stalls near the heavy strikes, the round numbers. Now that's the battlefield we're going to be seeing on Monday. Not just the real missiles and the aircraft carriers and the aerial bombardments, but we're looking at the options market. The public will watch missile maps. They'll see what's being hit, what's not being hit. But the professionals will see where the strike maps are, because that's where the pressure is going to leak, and that's going to determine how people are positioned into the future in terms of how they see the forward curve of prices in the oil market. Now, that leads me on to gold, because in gold we trust. It's the shock adjustment factor. It's the risk premium asset. It's the asset for safe havens. It's the shock and trust repricing asset, because gold is different. Oil price supply risk. That's what they price. It prices the supply risk, but gold prices the counterparty risk and the trust risk. Central banks collectively hold over 35,000 tons of disclosed gold reserves. Remember that word, disclosed, because annual mine supply is only 3,500 tons, but some way or shape or form, central banks are buying more than that in a year, because the disclosed amount is not actually the true amount, and there's a lot of conspiracies around that, but we'll get onto that in another video. Because when geopolitical stress rises, the real yields have to compress. Volatility expectations expand, understandably. People think there's going to be a more volatile future because of what they're seeing right now. And gold call demand is going to increase. Now, I'm not talking about spot prices here. I'm talking about option prices here, okay? Gold call demand for GLD or the junior miners or the major miners or the SLV calls, they're going to explode. If gold gaps into heavy upside open interest, dealers who are short the calls hedge by buying the futures. So it creates this virtuous, or unvirtuous for some of you, cycle of upward prices. Because as the delta increases, that's going to increase the hedging, the gamma is going to increase, the faith destruction is going to get all out of whack, and a lot of money is going to be either made or lost. But here's the structural twist in all of it. Gold often always spikes first, and then it consolidates unless something very particular happens. Real yields collapse materially. If that happens, the story and the paradigm changes a little bit, or escalation threatens systemic stability. Just look back to the 1970s. In the 1973 oil shock, inflation surged, duly, understandably, and gold had to revalue structurally. During the 1990s, gold spiked, but it later stabilized as the conflict was localized, and the markets deemed that this is not a contagion risk, this is a localized risk rather than a global risk. So what is going to be Monday's key signal? If the bond yields drop sharply alongside oil rising, gold continuation is most probably going to strengthen. And if the yields rise on inflation fears, gold may actually stall. If the dollar gets bid, gold may stall. But we have seen this dislocation between these markets before. We've seen this before. And we've seen now that the relationship and the correlation between gold and the dollar and real yields isn't as sacrosanct as we thought it was before. But that now leads me on to silver and the convexity being amplified. And the silver is thinner than we think. Because historically, silver volatility is often nearly double that of gold's during stressful events. Silver market's depth is much smaller. It's a smaller market. They've got less liquidity in there, but it's got industrial demand exposure, which complicates that narrative completely. Because with the industrial demand, there's a constant bid for it in electronics, in war armaments, and maybe even more relevant now, considering the backdrop geopolitically. If silver gaps alongside gold, upside call clustering can force exaggerated dealer hedging. But silver is unstable. It's volatile. When weekend gold is up 4%, weekend silver is up 8%. In normal times, if gold is down 10%, silver is down 35%. If oil spikes hard enough to trigger growth fears, silver's industrial component can really cap the rally. Because the reality of speculation and safe haven asset flows meets the reality of industrial demand. Because silver either becomes leveraged as a gold proxy or it becomes collateral damage in the eventual repricing. It's going to show you which regime we're in the first 2 hours if you watch how silver reacts as a proxy of gold. Because if silver outperforms gold percentage-wise, the convexity chase is surely underway. But if the silver lags, the defensive bid is there in its entirety. So watch that ratio. That's where the pressure is going to definitely leak. And now that leads me on to part 5, the liquidity, the plumbing that everyone finds so prosaic, so esoteric and so boring, but actually what determines everything in its entirety. Here's what most of the commentators won't mention. Large oil spikes hit a few things. They hit inflation expectations. They hit bond volatility. They hit forward curves and inflation expectations. They hit cross asset value at risk models. Basically, they're models that show banks how much they can risk in a day or in a quarterly or per time period. Risk parity funds, big funds out there with trillions or billions under management, they have to rebalance based on the volatility shifts. And that's where you get the CTAs. They're the trend followers, the big money. They follow momentum. They look at risk parameters, they look at trends, and systemic funds reduce their exposure when the value at risk models expands. And that's what's going to happen on Monday morning. Surely, the value at risk funds and the models and the maths and the pricing is all going to expand massively. Because considering on Monday, if oil spikes 10%, which I mean, on weekend oil, it's already up 10%, so I don't see why it's going to relent. Volatility is going to stay elevated, and the portfolio models are going to have to adjust. That's going to reinforce safe haven demand in gold, logically. That's what you have to expect. But if the oil spike fades very quickly, the volatility is going to collapse, the risk models are going to all stabilize, and gold may retrace. And that's how you need to be thinking about it. This is how commodities bleed into the entirety of the market. They bleed into equities because the safe haven bid is triggered. The risk off mode is catalyzed. It's not the narrative, it's the portfolio math, the CTAs, the VAR models, how they all interact and how they cause capital flows to get out of whack, and how they force rebalancing, which forces capital flows into certain assets and out of other assets. And by the end of Monday, you'll see the writing on the wall, and you'll see which regime we are in, and you'll see which way the market is pointing. Unless some institutional backing comes in and says, everything's all right, don't worry guys, we're going to come and bail out some market, or the war's going to be localized, it's not going to be globalized or regionalized. But here is the trap. Retail sees oil up. Retail traders are going to look at oil, gap up on Monday. If they were lucky enough, they're going to buy calls aggressively, and it's going to catalyze that breakout. But the dealers are going to absorb that flow. But if no confirmed supply disruption actually materializes, no Strait of Hormuz is actually blocked or mined, backwardation is going to relax. Volatility is going to compress by midday by the time those retail traders are waking up. That's going to force decay. It's going to force delta adjustment. It's going to force dealers to unwind all of those hedges. And the prices are going to fade incredibly, incredibly sharply. So you thought this was the move of the decade, the move of the century. Hey, I mean, Iranian oil is going to be off markets. The Strait of Hormuz is going to stop 20% of the world's global oil flow. Of course, it's bullish. That's what you thought. But the prices could just fade massively, classically in the face of everything. The shock is going to lead to a squeeze, which is going to lead to position exhaustion, which is going to lead to the unwind. But don't be the person who's caught on the unwind, on the wrong side of it. The first hour is often going to be the most violent. The second phase is going to dictate the direction of the trend henceforth. Is it going to last into a year-end event? Is this going to recalculate the calculus of where oil is going to be trading and priced at for the rest of the year? It's dark, but it's structurally true. War is going to lead to one or the other direction. And hopefully the collateral damage on the ground isn't what we're talking about, and rather something more prosaic, like the price of gas at the pump. But there is another scenario. It's called the continuation scenario. And that really prices in whether or not the escalation broadens. If we're going to see regional conflict, if we're going to see Bahrain get involved, Qatar get involved, Kuwait get involved, Saudi Arabia get involved, if we're going to see escalation for boots on the ground, troops on the ground, this massive record-breaking armada that the Trump administration has put into action, if it's going to actually lead to boots on the ground to a prolonged campaign before congressional approval at the 60-day mark. Gold continuation is likely under that scenario. Silver outperformance is likely under that scenario. Volatility is going to be sustained, which prices in those things for the forward curve markets. In that regime, the dealers of options are going to stay hedged. The gamma flows are going to increase and the upside is going to be accelerated and catalyzed. That's how the structural escalation is going to occur. Now, I don't want to sound fatalistic or like I'm catastrophizing or sensationalizing, but there is an inevitability framing to all of this as well. Every commodity shock follows the same pattern. Bar none. It's always the same pattern. The liquidity thins out, the options have to reprice, the dealers have to hedge, the price overshoots. It's always like that. And that's why you see an Eiffel Tower formation on these charts all of the time. The Eiffel Tower formation really appears in the end of these bullish markets, because once the prices have adjusted and the dealers have adjusted, the price always collapses. The escalation leads to the structural pricing, that leads to the stabilization, that leads to the regime change. 1973 was the same thing. 1990s was the same thing in terms of the war. It localized the shock, the gas hikes. 2019 proved that perception spikes can reverse very, very quickly in terms of COVID. This is not new. It's just how the structural flows dictate price to move. The mechanism is an ancient one, and it's interwoven with human psychology and with human behavior and the way we think in terms of risk aversion. Derivative concentration in terms of options and futures always have to amplify the shock, just mechanically the way they're traded in terms of their contract size and how their mechanics work vis-a-vis spot markets. And that's where the pressure is going to inevitably leak. So what should you be looking forward to on Monday? Well, hopefully world peace. But you should also be holding near to your chest a checklist, a Monday morning checklist, for want of a better phrase. Here's your battlefield scan if you're trying to trade these markets. Number one, does oil still hold above the gap in the first 90 minutes? Or does it completely collapse like an Eiffel Tower formation? Number two, does gold consolidate near the highs rather than just fade off? That's going to be repricing in a new paradigm that the world is not escalating into something more catastrophic. Number three, is silver going to outperform gold? Is the rate of change between silver and gold as such that it suggests silver is going to outperform? Number four, do the bond yields on treasuries rise, fall, or stall? Number five on your checklist, does implied volatility stay elevated, or is it completely crushed by midday in time for a sandwich? Number six, does oil curve backwardation steepen, flatten, or regress? If it's yes to most of those 6 checklist points, then we are in, my friends, a continuation regime. If no, then the shock premium is going to be evaporating, which means there's not much legs in the trade. That's simple, that's mechanical, that's unemotional, that's easily backtestable, and that's easily observable. And you can definitely trade that. Now, before I go and get back to the weekend gold, weekend oil, weekend silver, weekend equity charts, provided by IG, by the way, I'm not sponsored by them, but IG, if you're watching, holler at me. I don't know, I'm up for it. So this isn't about Iran. I mean, I'm wishing the best for the Iranian people under a tyrannical regime, a theocracy that needs to come to an end. But it's not about Iran per se. It's about the $100 million barrel per day system repricing risk rapidly. All prices supply the fragility. Gold prices trust the fragility. Silver prices the convexity of the fragility. And if you think of it in that way, you are off to the races. Option flows are going to have to accelerate in whatever regime dominates. They're going to reprice the risk, re-hedge the risk, rebalance the flows, and lead to the actual discovery of the price. It's going to leak out slowly or it's going to leak out quickly. And by the end of Monday, you're going to know exactly where the pressure leaked first. But are you going to be on the right side of history or are you going to be on the wrong side of history? I don't know. But all I know is that I'm hoping for the best for the people of Iran. And my name's Justin Manson. And ciao for now.